When Barcelona partners in crypto, the red flags follow, and the world pays attention as the partnership is suddenly surrounded by shadows, unanswered questions, and the unmistakable scent of déjà vu. This is the story of how one sponsorship deal became a case study in hype, risk, and investor responsibility. Stick around till the end, like and subscribe, because this is going to be a roller coaster ride. The story opens with FC Barcelona unveiling a 3-year sponsorship agreement with a barely visible crypto outfit called Zero Knowledge Proof, a Samoa-registered entity with almost no prior footprint. On paper, it looked like another big club stepping deeper into Web3. But then the real signal emerged. Just days after the announcement, ZKP launched a 200 million token auction, parading claims of heavyweight backers and breakthrough technology. For any serious analyst, that sequencing alone is a red flag. When a sponsorship headline is followed immediately by a token sale, you're not looking at organic growth, you're looking at manufactured demand. And when the counterparty sits in a low-disclosure jurisdiction with limited team verification, unproven tech, and no audited architecture, the risk profile spikes sharply. This isn't just interesting timing, it's a structural warning. When marketing momentum arrives before fundamentals, the incentives rarely align with investor safety. And when timing looks too perfect, the next question naturally becomes, who exactly are we dealing with? When we started digging into this project, what we found, honestly, it was almost nothing. No real public footprint, no verified leadership, no credible disclosures about investors backing the venture. Just a name, a deal, and a token sale that on the surface looked perfectly timed with Barcelona's massive spotlight. Let me break it down. In the world of crypto, credibility isn't optional, it's foundational. Think of it like buying a plane ticket. You want a real airline with licensed pilots and verified routes, not a cardboard plane someone drew on a napkin. Here, we didn't see any of that. What's more, the timing is eyebrow-raising. Days after the sponsorship was announced, the token option went live. Suddenly, Barca's global reach, the stadiums, the social media, the press coverage became the marketing engine for an extremely speculative asset. Imagine a world-famous celebrity giving a shout-out to a friend's untested product. The exposure is massive, but the risk even bigger. And that's the thing. Hype can feel like legitimacy, but in DeFi, hype alone isn't a safety net. Real projects have a public footprint, transparent leadership, and verifiable backers. If you can't see who's behind it, you're essentially investing blind. And Barcelona, realizing the mounting pressure, did what many institutions do when the fire gets too close. Barcelona quickly tried to draw a line, saying the partnership had nothing to do with the token itself, no issuance, no adoption. But here's the tricky part. Reputational damage doesn't work in reverse. Once a brand this massive steps into a story, it's like dropping ink into water. You can't just scoop it out. In DeFi terms, think of it as impermanent loss for reputation. The moment your name touches a speculative asset, the perception spreads, whether or not you approve. Timing, messaging, and clarity matter, because undoing the narrative is always harder than controlling it. Because contrary to what PR teams might hope, this isn't just about optics, it's about how fans behave when they see their club align with crypto. Legally speaking, a sponsorship isn't the same as an endorsement. Just because a club's logo sits next to a crypto project doesn't mean they're vouching for it. But emotionally, that's a completely different story. Fans don't parse legal fine print. They see their team's badge beside a new crypto brand, and in an instant, it feels legitimate. Legitimacy in this context is powerful. It's like walking into a high-end store. The fancy packaging convinces you the product must be good. In crypto, that feeling can turn into irrational confidence. People start buying tokens, NFTs, or other digital assets they barely understand purely because their favorite club appears associated. This is exactly why predatory actors love sports partnerships. It's a shortcut to trust, a way to bypass due diligence. In DeFi terms, it's social proof turned into leverage. The moment a respected brand touches a project, many assume safety and skip the homework. And if this feels familiar, well, it should. This isn't Barcelona's first stumble in the crypto space. A few years back, they had to cancel an NFT partnership with Ownix after a consultant connected to the project got arrested. Different year, different partner, but the pattern? Almost identical. Let's unpack that pattern. First, there's hype, the excitement around new digital assets, flashy launches, and headlines that scream, "Get in now." Then comes urgency, FOMO, fear of missing out, pushing people to act before they've done their homework. And finally, poor due diligence, not thoroughly checking the people, the tech, or the financials behind a project. Mix these three together, and what do you get? A disaster waiting to happen. In DeFi, it's like rushing into a liquidity pool without checking the smart contract code. The numbers might look appealing, the platform might look polished, but one unchecked variable can wipe out your funds, or in this case, a club's reputation. Even globally trusted brands are vulnerable to the same crypto pitfalls as any individual investor. Hype alone doesn't equal safety. Due diligence, transparency, and verified leadership are non-negotiable, especially when fan trust is on the line. And if you think this is merely a club problem, look deeper. The jurisdiction tells its own story. ZKP is registered in Samoa, a jurisdiction known for minimal disclosure requirements. What does that really mean? In plain terms, it's like parking your money in a vault where the doors don't have locks and no one is watching. Less transparency, fewer accountability structures, and almost no real oversight. In practical DeFi terms, it's a structural risk, not just a PR problem. If something goes wrong, misappropriated funds, faulty code, or outright fraud, tracing money or taking legal action becomes extremely difficult, sometimes near impossible. Imagine trying to recover stolen crypto from a project that doesn't publish verified team information or maintain standard regulatory safeguards. That's the situation here. Structural risk differs from hype-driven reputational risk. PR risk is a temporary dent to your image. Structural risk is baked into the foundation. It affects the core safety of funds and trust. Where a project is registered and the legal frameworks it operates under matter just as much as the tech or marketing. Global fame, like a football club sponsorship, doesn't change the underlying exposure. Always assess the foundations, not just the headlines. But the biggest danger hides beneath the marketing strategy, where brand equity becomes the fuel for liquidity games. A sponsorship like this isn't just marketing, it's a shortcut to instant credibility. Suddenly, a crypto project gets access to millions of emotionally invested fans who trust the brand they love. That trust, in turn, fuels demand. In simpler terms, it's like putting a shiny new product in the hands of a celebrity's followers. The hype alone drives sales, even if the product hasn't been properly tested. In crypto, this is what we call demand manufacturing. It inflates attention, sparks FOMO, fear of missing out, and primes the market for a classic pump-and-dump scenario. Think of it like a playground seesaw. Hype pushes the price up, retail investors rush in, and then the heavy hand of insiders unloads their tokens, leaving the rest holding the bag. This isn't theoretical, it's a structural pattern we see over and over in speculative markets. The combination of brand trust, emotional attachment, and poorly understood products is exactly what predators look for. And this leads us directly to the oldest imbalance in financial history. Here's the market reality. Institutions buy fear and sell euphoria. They step in when prices are depressed and they exit when the hype peaks. Retail investors, by contrast, often do the exact opposite, buying when excitement is high and selling in panic when prices drop. It's a classic pattern in speculative markets. Now, add a global sports brand into the mix and things accelerate dramatically. Brand trust amplifies emotion. Fans see their favorite club associated with a token and their excitement spikes. Suddenly, retail euphoria isn't just high, it's moving at triple speed. Think of it like a roller coaster. The tracks are already steep with volatility, but when a trusted brand throws its weight behind the project, it's like launching the ride into overdrive. Retail investors rush in, driven by hype rather than fundamentals. In crypto terms, this is what we call exit liquidity. The trust fans place in the brand becomes the very pool of buyers institutions need to offload their tokens. In other words, what feels like legitimacy and momentum to retail is often a well-timed opportunity for insiders to exit. But the damage doesn't end with investors. Clubs pay a long-term price too. In the world of sports and crypto, a single shady partner can have ripple effects far beyond the initial deal. It can erode ticket sales, scare off potential sponsors, and chip away at fan goodwill, the intangible trust that takes decades to build.
clubs often underestimate just how deeply a Web3 scandal can scar their brand equity. Brand equity isn't just logos and merchandise, it's the perceived value, the reputation, and the trust fans and partners place in the organization. Once that trust is shaken, the effects are long-lasting. Barcelona's rapid distancing statement wasn't merely a clarification. In DeFi terms, it's like a project issuing a patch after a smart contract exploit. It signals that the damage has already started. The reputational burn, the loss of credibility, fan confidence, and perceived legitimacy was already underway the moment the questionable partnership became public. And beneath all this lies a bigger moral issue that sports organizations must confront. Let's be clear, promoting speculative financial products to emotionally attached fans isn't innovation, it's exploitation. In crypto, hype can feel like opportunity, but when that hype leverages loyalty, it becomes a tool for persuasion, not investment guidance. Think of it this way, if your favorite football club endorses a token, it's easy to assume it's safe. Emotion clouds judgment. Young fans, excited and trusting, often buy in without fully understanding the risks. They're not investing, they're being marketed to. And unlike traditional finance, there are few protections in place here. No guaranteed disclosures, no regulatory oversight, no safety nets if things go wrong. It's like stepping into a high-stakes game without knowing the rules.
Most fan tokens offer very little real utility. They're built on branding, not fundamentals. In other words, the appeal isn't in what the token can do. It's in the club name, the logo, and the hype surrounding it. From a DeFi perspective, these tokens are structurally weak. Low liquidity means it's hard to buy or sell without affecting the price. Opaque governance means holders have little say over decisions, leaving them dependent on a small, concentrated group of insiders. And concentrated holdings mean a few wallets control most of the supply. If they move, the market moves. Branding can inflate sentiment temporarily, like glittering packaging on an empty box, but it can't fix tokenomics. Tokenomics, how the token is distributed, governed, and maintained, is the backbone of any digital asset. No amount of marketing can make structural weaknesses disappear. So how do investors protect themselves? By shifting from emotion to evidence. Before putting any capital into a brand-affiliated token, you need to do more than glance at the logo or trust the marketing. Start with the legal entity behind the project. Who actually owns it? Where is it registered? Without this, there's no accountability. Next, check for smart contract audits. Think of these as security inspections for code. A token without an audit is like a building without structural certification. Anything could collapse. Verify the identities of the team. Anonymous developers aren't inherently malicious, but anonymity adds risk. Confirm actual liquidity, too. If it's hard to buy or sell the token without moving the market, that's a red flag. Understand vesting schedules, who holds how much and when they can sell. Review regulatory registration. Some jurisdictions require certain filings for financial products. Finally, scrutinize contract clauses that limit token promotion. These rules can affect whether hype or partnerships are driving value artificially. If any of these elements are unclear, you're not buying a token, you're buying unregulated equity with a mascot. And in DeFi, emotion doesn't pay bills. Structure, transparency, and verified fundamentals do. And at this point, it helps to remember that not all of Web3 is built on hype.
Between 2024 and 2025, blockchain didn't just trend, it matured, especially in emerging markets. We saw real traction where it actually matters. Faster payment rails, cross-border settlement systems, and digital identity frameworks built on-chain. These aren't buzzwords, they're institutional-grade innovations reshaping how money moves. Think of faster payment rails as highways without traffic. Instead of waiting days for transfers to clear, funds arrive almost instantly. Cross-border settlement? That's like removing all the toll gates between countries, fewer intermediaries, lower costs, and cleaner transparency. And digital identity systems? Imagine carrying a single, verifiable ID that works across banks, apps, and government services without the bureaucracy or fraud risks. This is the real frontier of blockchain adoption, solving infrastructure problems, not selling memorabilia wrapped in tokenomics. And that's why it's important to draw a clear line. These advancements exist in a completely different universe compared to fan tokens and speculative hype cycles. One is about upgrading financial infrastructure, the other is about monetizing emotion. Which brings us back to Barcelona and ZKP. Where does this story go from here?
Best case, ZKP turns out to be legitimate with real tech and governance, the partnership stabilizes,
Unlikely, but theoretically possible. Middle case, ZKP survives but the token flops. Barcelona takes the reputational hit and tightens future vetting. Worst case, token collapse, legal fallout, fan outrage, regulatory intervention, poisoning the well for all future sports and Web3 collaborations. So what should investors and builders actually do with this information? Never buy a token just because your favorite team put a logo next to it. Treat every token like startup equity. Check the team, check the product, check the audit, check the legal structure. If all you see is a shiny press release and a token sale, that's not opportunity. That's a red flag waving in your face. If this resonates with you, check out the card above for more interesting videos. This is Blockchain Money.